Hey everybody, welcome to another episode of Navigating Real Estate Turbulence. I'm John Lafferty with Century 21 Town & Country.
And I am Tony Abate with Ross Mortgage.
Well, today we have an interesting topic, and I'm kind of excited to hear about it. We're going to talk about renovation loans, and if you're a buyer in this current market, you pretty well know that there's multiple offers on properties, especially ones that have been updated and are pretty much move-in ready. The ugly ducklings out there, or let's say the ones that are dated or maybe need some work or some updating to make it look how you want it, to bring it into the 2020s, those don't get as much love.
Sure.
And so for buyers out there who maybe don't have the 20% down and don't have the extra cash to do some of these things that you need to do to get your offer accepted, a renovation loan opens the door to be able to look at some properties that may not necessarily, on the first go around, you maybe not see the possibilities, but with renovation financing, I think it's exciting for them to have this option because now they can actually look at some of these homes with dated interiors through different lens.
Right. Mm-hmm. Yeah, for sure. You know, it's a tool to help a buyer not have to, they can still buy a home, but not jump into that fray where they're in the boxing ring with buyers that are making big down payments or cash buyers or what have you. The renovation loan programs are not new. They've been around a long time. The most common and well-known one that is probably also the oldest renovation loan program is an FHA 203K loan. They've been around, they certainly predate me in this business. And shortly after that, conventional loans came into the fray with a program called Home Style Renovation Program. And VA actually has a variant as well. They're not household name products. They're not used on every transaction. They're kind of an opportunity product, right?
Mm-hmm.
I don't think home buyers come to you and say, John, go find me a home that needs to be renovated. It's more of a, when you're looking through the subset of homes that are available, well, here's a couple that are meeting a lot of the bullet points, except for a couple things. And what do you know? A renovation loan can provide a solution to that. And I guess as it relates to this market, let me kind of give an analogy because I think you would agree, inventory is tight. It's been tight for a long time. There's not a lot of options out there, and buyers can't be picky. Sellers are calling the shots right now. So let me kind of do a comparison. Let's say that you're in the market for a new pickup truck, and you want to have a pickup truck with a trailer hitch on it, because you got a trailer that you want to tow or a boat or something like that. So you go to one dealership and they've got 35 of them on the lot and 15 of them have trailer hitches. So you've got choices, right? You want the blue one, you want the white one, you want the black one, whatever the case may be. But let's say you go to the lot and they've got two pickup trucks and neither one of them have a trailer hitch on it. And so then you might have to say, well, you know what? I don't have a lot of choices. Their inventory is tight. But I know that I can still buy one of these pickup trucks and add a trailer hitch. That's the renovation for that kind of a comparison. And so in a similar way, a home buyer who's in the market today, who doesn't have tons of choices because that inventory is tight, they might say, okay, we found a house. It's where we want it. It's the size that we want it. It's got the yard that we want. It's got the two-car garage that was important to us. But holy cow, that kitchen makes the Brady Bunch kitchen look great. And in another market, they might pass that home by, right? And say, don't like it. That kitchen is a deal killer. Now, though, if there's not a lot of other choices on the market, one of the things that they can do is say, all right, you know what? It's got a lot of other positive things to it. Let's make an offer on this home. We'll use renovation financing for the purchase. And then we can redo that kitchen and bring it up to speed and use our choices, the contractor we want, the materials that we want. We're going to make it look like ours. So that's why I think the timing is really relevant right now in this market, because not every buyer can put 50% down. Not every buyer can do appraisal guarantees. These are still viable buyers that are, if we don't help them sell a home or buy a home, somebody else will, for sure. And it's good for that buyer, right? It makes the home theirs. And it's good for the neighborhood too. It's a tool that can bring a property value up that was maybe being held back because of those lack of updates or deficiencies that might be out there within that home.
Yeah, that's. I think it's another tool to have in your tool belt, right? To be able to work with buyers. I mean, the last thing you want to say to an FHA buyer or a 3% down conventional buyer is, let's just hang it up and I'll see you in 6 months or a year when the market's not as crazy. Mm-hmm. I don't think that's necessary. I think this tool here opens up the possibility for them to be able to still get a house in the area that they're looking, and it doesn't have to be, a house with the avocado green and the burnt orange colors in it,
Right. So let's kind of paint the picture as to what this program actually does. Mm-hmm. And there's more similarities than differences when we're looking at the FHA renovation, the conventional renovation, and so on. So here's what happens. We'll go back to that example. Let's say that home with the terrible kitchen is $200,000. And this home buyer is ready to put 5% down, which is $10,000, okay? But they know that to redo that kitchen, I don't know, what's a renovation kitchen cost these days? What might a person pay?
You can pay, let's just say, if you're gonna do granite and new cabinets, new flooring, anywhere from $20,000 to $50,000, $60,000, $70,000.
Really? Yeah. Crazy. Okay, so let's pick a median. Let's say it's $30,000. So now we have the sale price of a home at $200,000, and then the cost of a kitchen renovation at $30,000. So all in, this buyer needs to find a way to spend $230,000 on this home to make the magic happen. So what they can do is that they can make an offer to purchase this home at $200,000 and find a contractor to prepare a bid. And using your example, they'll come up with a cost of $30,000, and we can finance that extra $30,000 into their loan so that they can purchase the home plus have those funds available to do the renovation. We're going to put a screen up that shows the same idea with a little bit different set of numbers, but you're basically folding the cost of that renovation into the mortgage.
Can I pause you there and just ask you, you're looking at a house, and let's say that the roof needs to be replaced. Maybe it's even leaking a bit, but the intention is we're going to put a new roof on it. Can they do a renovation loan for that?
Yes.
Okay.
Yes.
Kitchen's gutted. There's nowhere for a stove, a fridge. It's not livable in its current set. Can you get a renovation loan on that?
Yes.
Okay.
Yeah. So one of the ways I like to describe this to people is that you can do repairs that are required, and you can do renovations that are desired. You can combine it both all in the same package. And I think one thing that's important for buyers to know, because with the tools that you have available, where home buyers can do their own searches and enter their own criteria, what do they come across a lot with some of these compromised properties? It'll say cash only, right, in the multi-list. And the immediate reaction is pass, move on. But with the knowledge that there's renovation financing available, maybe it's, peel back the onion a little bit back in that one and have a conversation with the listing agent to say, well, what's making it cash only? And it might be something like you just described. The listing agent might say, the roof is shot, the seller does not have the funds to repair this roof. And so the listing agent appropriately said cash only, because he knows that a home that's got a roof that is not functioning, it's leaking, it's on its last legs, can't get a mortgage on it. Okay, so if the listing agent is knowledgeable about the program, though, he can market it as, talk to a lender about renovation financing for this home. Chances are it's priced accordingly, right? A good listing agent is going to adjust that price to accommodate the fact that there's a deficiency. So it's not like that buyer is double paying, right? The home in a perfect world, is discounted accordingly, and then they can fold in the cost of that renovation, get that roof, and include other things that they want, right? They might say, you know what, we got to do that roof or it's not going to happen, but boy, that bathroom could need a little TLC, or the kitchen, like you said, and it can all be wrapped into the renovation loan, and all this work happens after the closing, which is good for the seller.
It is.
Mm-hmm.
How does an appraiser assign value to a brand new roof,
Mm-hmm.
which is, it's considered, when you're selling a home, you may say, hey, new roof this year, brand new roof, or new mechanicals
Mm-hmm.
within the last year. We know that a new roof can, depending on the roof and the style of the roof, I mean, you could spend between $8,000 and $30,000 for new shingles and a new roof being put on, especially if they got to pull the boards off.
Right.
So how does an appraiser assign value? Because in the real world, just because a seller puts on a $10,000 roof doesn't mean he's going to sell the property for $10,000 more.
Right.
There's that trade-off isn't there. So how does that work?
Yeah. No, that's a valid point. And one of the things that has to be considered with the renovation loan is the impact of maybe an over-improvement, which is not what you're describing, but it's kind of going in that direction. And I'll state the obvious. We don't get a dollar for dollar benefit when we do a home improvement. So in other words, you do a $30,000 kitchen, and you can't automatically sell it for $30,000 more, right? So what an appraiser can do, and we talked about this before, it's not an exact science with what these appraisers do. They say, well, what's out there as far as comparable sales with homes that are similar, but they don't have a deficient roof? It's more in line with what the subject property is gonna be after the renovation loan. And that's what they do. They'll factor in the brick and mortar cost, if you will, but then they'll also see what are comparable properties selling for that don't have that deficiency. Because here's another thing, and confirm to me if this is correct, but this is what I saw, especially when we were dealing with a lot of REO properties back in the recession, and that is, if a property cannot be financed because of a deficiency, and the only pool of buyers that they're entertaining is cash buyers, they're going to discount the price of that property beyond the cost of the repair. So in other words, let's rewind button back to when there was a lot of bank-owned properties being sold.
Mm-hmm.
If the furnace was missing, right, which happened, right, it's just gone. They put the home on the market for a price that is lower than maybe the $4,000 or $5,000 because they have to incent the cash buyers.
If it was any other time than the time we're in right now, I would agree with you.
Right.
But we are in a strange time right now where that isn't the case.
Yeah. Mm-hmm.
So that's kind of where I was going with that question is when you have a property that it's not in a normal market where you're absolutely right. If it needs a new roof and it's cash buyer only and they're not doing renovation financing, yeah, that's absolutely, that property is absolutely discounted. And because of the cash buyer, you're not paying retail for something you got to plow 20 grand into or 15 grand into right off the bat, or put in a new furnace and air conditioning and the mechanicals. You're not paying retail for that either. But in this market, people are paying, even cash buyers are paying retail. They're paying a premium for these homes that need these things. So in this crazy market, how do we navigate that?
Well, there is a solution. And let's compound it. The cost of materials are exaggerated as well, right? So, and I had a conversation with the roofer yesterday, and so it was an eye-opening experience for me too. But you're compounded by two things. Number one, the known fact that we don't get that dollar for dollar benefit for value when we pay for an improvement. But also two, now we have the exaggerated price of the improvements that are being used. The solution is the FHA variant of the renovation loan, and that is the 203K loan. And the reason for that is that HUD did something that's pretty darn smart, and this is the only program I know that does that. But it's this: when you're doing a renovation loan and you're doing the FHA variant, which is the most popular of the renovation loans, you have a 10% appraisal window. that can be used to accommodate that sort of thing. So, rough example. Well, we'll go back to the one that we had. Let's say that, so we've got that $200,000 home. Person wants to put a $30,000 kitchen in it, so hopefully it's going to appraise for $230,000. But as long as it appraises for $230,000 plus or minus 10%, then you're okay with that renovation. So what is that? That's a $23,000 window. That's substantial.
It is.
That's what keeps those deals together in that situation. In fact, in this market where people are paying premiums, that can be the deal saver. If the appraisal comes in low and there's an opportunity to layer a renovation loan into the package, everybody wins. The seller can retain their price. The buyer can switch to a renovation loan, maybe when they weren't even considering doing a renovation loan. But they say, which house is perfect? None of them, right? I mean, any buyer is going to say, if I had my druthers, this would be replaced, or this would be improved, or whatever. Mm-hmm. So you go the other direction. For that home that appraises low, and nobody wants to budge because we're in the market that we're in, renovation financing can be used because now you've got that 10% appraisal variance, and then you look to a renovation that might be necessary. If it's a home that, or desired, if it's a home that doesn't have central air conditioning, maybe you use a renovation loan to put in central air conditioning. So it's not going to work in every situation, right? But when you have that situation where you've got a home that has some opportunities and that appraises low, and let's face it, the parties have, they're willing to be flexible to let the renovation product go through, then everybody walks away happy.
Wow, look at you, finding a new way to get a buyer with a smaller down payment to make it work on a low appraisal.
Every now and then, the spark plugs fire, But, and it's a win-win, right? Because the seller didn't have to compromise. The buyer can make an enhancement to the home that maybe they thought was going to have to happen at some unknown date down the line. Mm-hmm. So it is a cool solution. It's a good tool to have in the toolbox. It's not going to work in every situation.
For sure. Yeah. And I know we're going to dig into the slides in a moment. So before we do, question, is there a cap on renovation financing of how much you can actually use for repairs and renovations on a home for a 203K and for your renovation program?
Sure. So on the 203K, you're really only capped by the county FHA limit that exists.
So, for example, in Macomb and Oakland, it is
$348,000 and some change. Yeah. On a conventional loan, there's a little bit of a different metric that comes into play, and that is the cost of renovation should not exceed 50% of the final finished value. Okay, so we'll use our example. When we have that home that's being purchased for $230,000, and in this case we talked about a $30,000 kitchen. But what's 50% of $230,000? I should be able to do that in my head, but I can't. $115,000. Thank you. I'm not always good with numbers, but so in that case, if the renovations don't exceed $115,000, which is substantial, that's a lot of renovation, then you're okay even with the conventional loan. So I would submit that hitting the stops on what a renovation loan can and can't do takes a fairly extreme scenario, like a full gut type of a loan. That's where the conventional variant may not be the best tool.
Okay.
Yeah. Where do we cross that line into, when we're not doing a renovation loan and now it's really a construction loan is what we're talking about. So there's a few things that a renovation loan can't do. I got a slide for that. Let me see here. So you can't do a demolition. Okay. You can't. So in other words, you can't knock down a home and completely rebuild it with a renovation loan. You can't move a home. We see that from time to time, right? The 1890s Colonial sitting on a flatbed going down the street. Can't use a renovation loan for that. The other thing that you can't use a renovation loan is to renovate a loan that's less than a year old. Okay, and the idea there is what the program doesn't want to accommodate would be a scenario like where a builder started to do a construction and then just stopped. maybe abandon the project because of lack of funds or whatever reason. So a renovation loan isn't used or can't be used to kind of pick up the ball on new construction that wasn't completed. Okay, so that's where a pure construction loan comes into play. Okay, some things that can be done. We've got some screens for that. So upgrading HVAC. We use the example of adding central air to a home that doesn't have one. Plumbing and electrical upgrades, flooring, you got that shag carpeting, you want to switch out to hardwood, you can do that. Window and door replacements, exterior re-siding of a property. We talked about roofs, that's a big one that can be a stopper on a purchase. Gutters, downspouts, decks, patios, septic systems and wells. So for the properties that are in Macomb County, you've got to have that septic inspection, right, before a property can convey. 9 times out of 10, they're fine, right? And everything goes along fine. But if you have that situation, kind of like what I was describing, where you've got this deficiency, maybe this is a situation where the inspection says that septic system has to be replaced.
Can we pair with that main line that's collapsing from the house to the street that connects to the city sewer, and that has to be dug up and replaced? And if you've got to break a concrete sidewalk pad and you've got to dig up part of the street because you've got to connect because it's in the middle of the street.
Right.
I mean, you could be talking $15,000, $20,000 for that.
Right. Well, what I can say is that's a good question. I'm gonna circle back on that one, as they say. But so what you can do, you can use the renovation loan to hook up to water to the street, if you're on a well, for instance, and you can use the construction loan to hook up to sewer, to tap into a sewer line if you're on a septic and you need to go to sewer. I can't say whether those lateral lines, as they're called, if we can use that renovation for repair, but I'll check on that to see.
Okay.
You're right, big numbers when that kind of thing happens, and it does fall on the homeowner. The biggies are the kitchens and bathrooms that always catches a buyer's eye. Painting, weatherization, storm windows, critical item, definitely for the government loans, but really it should be a watchful thing for any home buyer is when there's damaged lead-based paint in a home. So you have those homes prior to 1978, right? For the lead-based, yeah. So if there needs to be lead-based paint abatement or stabilization, you can use a renovation loan for that sort of thing. If you're redoing the kitchen, you can include the cost of the appliances in that renovation loan, and that's kind of a neat thing because technically that's personal property, right? The fridge or what have you, but you can include that in the renovation. Another important one is accessibility for people with disabilities. So if a home buyer has special needs and they find that perfect home, but it's got to have ramps or it's got to have access ways widened or rails put in, you could use the renovation loan for that. Basement waterproofing, there's another stopper, right? We talked about this before. Water in the basement, typically everything stops with home financing, and for good reason, buyers might back away as well. But if the problem can be identified and it's a reasonable cost, you can use the renovation cost to make a foundation repair and do waterproofing.
In a situation where a basement has been waterproofed, but you have walls that are bowed, poured concrete walls that are bowed because of the pressure of the water, and so they've had to add steel piers in that to stabilize. Would a lender allow somebody to still finish a basement like that that's dry, but would they consider that because that work's been done secure and dry, and therefore, go ahead with the renovation financing?
So what I can see needing in a situation like that would be additional inspection from either an engineer or a foundation expert that says this foundation has been modified to address the deficiency, but it's safe. We see in some of those situations, there's often a warranty or a guarantee that comes along. That becomes an important issue as well, because then if something does fail, it's on the backs of the contractor that did that work. So probably a little extra digging to determine are the repairs safe and secure. But yes, if a person wanted to buy a home that's got those types of repairs and they wanted to finish the basement, if it's a green light on the repair that was done prior to, then yes, be okay with that.
Oh, okay.
Yeah.
That's interesting. One of the things that I didn't hear you mention is you've got a 2-bedroom, 1-bath house, and you want to expand that to a 3, and third bedroom is going to be a master suite. with the bathroom and maybe a walk-in closet. Can you do a renovation loan on that?
You bet. Yeah, you
Hey.
can change room count. You can even change living space numbers. So if you have, what would be an example? Well, if you have an old duplex and you think, you know what, this would make a really cool home for one person, but as a duplex, it's not really what I'm looking for. Zoning approved, then you can change that two-family home into a single-family home. So you don't have to stay with the unit count that the property comes with. You don't see that a whole lot.
Flip that.
Sure.
Can you still
yes.
do it?
Yes, you can. You can take a single family home if it makes sense, right? I mean, if there's some homes, and you see it's more than I, you can envision, holy cow, there's bedrooms over there, there's bedrooms over there. We can make this into a duplex. There's a bathroom on either side, but with, you need the division, you need the separate entrances and things like that. Yes.
Well, and let's be honest. I mean, one of the things that our consideration for buyers now are extended family homes, where you have, husband, wife, maybe children, and mom and dad, or mom or dad living in the home. So I could see a scenario where having these separate quarters almost, where there's a kitchen, there's a family room, there's a bedroom or beds over here with a bath, and the same thing over there. So, the extended family kind of have their own areas. There's seeing a lot more of that, where you have multi-generational households.
Yeah, for sure. That is definite. And that's something that the lending community has actually, on a different topic, have expanded guidelines to accommodate that, because it is becoming more commonplace. So a couple of cool things that can be included with the renovation that I'll talk about here is you can fold in what's called the contingency reserve, which is just a stopgap that says, what if we run out of money? Maybe there's a cost overrun or something to that effect.
Like lumber going up?
Like lumber going up, exactly. But because what the lender doesn't want to do is create a situation where the project can't be finished, right? That's risky for the lender, it's bad for the home buyer, it just isn't good. So 10 to 20%, and there's characteristics or parts of the project that would determine which of that, where that's appropriate. That is basically just money that's there in the case of an overrun. Now, if everything goes well and that money's not used, it's not lost. That money that was parked off to the side, it's just used to pay down the loan balance when the project is finished. That way the home buyer is not borrowing more money than necessary. In situations where the renovation is extensive to the point where they have to live somewhere else, you can actually include 6 months of your house payment in the renovation loan balance that you can pull from to make the mortgage payments if you need to. Again, if you don't need to, at the end of the day, then that money gets folded back into the loan.
Yeah, that's good. And let's just take my example again of, let's say, adding a third bedroom and a bath to a home. There's walls that you have to knock out. There's a slab that has to be poured, or if you're going to do a crawl, that has to be done. Everything has to settle before you start actually the build of that, because the last thing you want is to have that it's not level.
Right.
And so, is there a certain time frame that this has to get done? If you're doing an addition like that, I've been told by some construction, in order to do it right, you've got to set the foundation, you've got to leave it there for a while, let it settle. I don't know what that time frame is before you actually start construction on it. So what's the time frame on something? The desired guideline is 6 months. We want to have that project wrapped up. The longer period of time where a home is under a state of construction, the greater the risk is for everybody. And so 6 months is really the line in the sand. Okay. It's important now, I'll talk about the elephant in the room. Contractors are spread a little thin right now. And so I think the scope of the work and the completion is something that's important. If you're kind of doing a one-off, you need a roof replaced, that's a pretty manageable thing. But something extensive like that, I think it's a very transparent conversation with the contractor that says, what's my time frame here? And it may make it unfeasible, right? I mean, if the timeline is extensive, 9 months, 12 months, this probably isn't the program to use. Well, I will tell you from firsthand experience that getting a contractor to come out in a time frame and do a quote, an actual quote, write it up so exactly how the lender wants it submitted. Because most of these contractors who build, they know what a lender is looking for. I've had them charge clients money in order to do that. And under normal circumstances in a normal market where things weren't so tight, that wouldn't be the case. They would do it in hopes that they would get the job. But there are construction guys now who are doing these quotes or show up and say, what are you going to have done? Oh, that's it? Oh, it's not worth my time.
Right. Yeah.
You know, so you go through 1, 2, 3, 4 different contractors before you finally get one who can show up after. So I love the idea of this program, but you're absolutely right that it's a challenge right now. So you almost, as a buyer agent with your buyer client, is you've got to start a conversation with construction people. If that's where you're going and that's your goal and that's the kind of house you're going to buy, you've got to start that conversation early on before you even find a house, just to make sure that that person isn't going to ghost you or show up and say, yeah, I'll write and never do it.
Yeah, you're right. There's a little bit of a stopgap in there in that, you know, when these bids are being done, ideally, that's right after the contract is accepted, right? And now stuff can happen. You know, the 6-month time period doesn't happen until the transaction closes. So even in the best situation, you know, you're 4 weeks plus in that. So it helps a little bit to bake a little time in there. But it's an important part of the conversation is the scope of that project and so on.
Yeah.
You know, 2 things that are really important as we look to wrap up on the topic here is, number one, these are not loans in which a person can do a do-it-yourself project. So in other words, it's not simply a bucket of money that's made available and then they can add their own deck and so on. It's got to be licensed and insured contractors. The other thing is that when you're doing projects that have multiple pieces to it, you really got to be hiring a general contractor. This is not the program or the time for a buyer who, let's face it, has not done this kind of thing before in most cases to decide, I'm going to hire the electrician, I'm going to hire the plumber, I'm going to hire the carpenter, I'm going to hire the painter, and I'm going to coordinate them all to work together, and I'm going to get the necessary paperwork from all those contractors in a timely fashion to make the deal go. As opposed to, you've got one general contractor, one point of contact to make all that happen. Then it's the general contractor's job to coordinate the scheduling of all those guys. So those are 2 really important things. Do you save money hiring your own contractors? Yeah. You only save money if the project works, right? I mean, if it never comes together, you haven't saved a dime and you probably spent money. And so,
what are the 3 things that you can never have?
Help me out.
You can hire somebody who's going to do a really good job and you're going to be totally happy with it. You can hire somebody that's going to give you a decent price.
Oh, yeah.
But it may take them forever to complete it. So good work, good price, and an appropriate time frame never happen at once. You can have somebody that does it quick, but you'll never get them to do it cheaply because they're going to be doing other jobs where they're making more money.
Yeah.
Or if they say they can do, hey, I'll do it for this price. I'll do it real cheap. Yeah, they're never going to get done.
How's that go? So it's fast, good, and cheap, and you can pick 2.
Yeah.
Right.
Pick 2 out of 3.
Right.
Sometimes you only get 1.
Yeah, exactly. So this is just a great alternative for folks that are looking to buy a home and maybe they've got limited funds. They're willing to look at homes that need a little TLC. And it's a great message for sellers as well who are thinking, I'll never get this home sold because of whatever. I got to hook up to the sewer. My roof is shot, whatever the case may be. And if they wanted to, I think the math would have to work out right. A potential home seller could use this program as a refinance tool to do the renovations first and then go to the market and sell the home. I think it'd be a little difficult to justify the dollars in that case, but a person could. Or the other alternative that we're seeing, if somebody doesn't want to get into the home buying fray, they're saying, I'm just going to renovate my home and stay. They can use this loan program to pay for the cost of renovation, without coming out of pocket. The rates are just a little higher than a regular conventional loan. So it's a nice fixed rate product. Now they can renovate that home. Now they can stay there another 10, 15, 20 years knowing that they've made it the way that they want it.
And so that's the difference between a renovation loan and a home equity line of credit.
Yeah, and there's an important distinction here too. So it's all tied to that equity amount. Sometimes that question comes up. Why don't I just go up to the bank and get an equity line of credit and do this stuff on my own terms at my own pace? The big distinction is this. With a renovation loan, the amount that you can borrow is based on what the appraisal is gonna be after the work is done. So you get that bump in value that the lender can lend against. When you're doing an equity loan, even if you tell the banker, hey, I'm finishing this basement, I'm gonna put in those Pella windows, here come the Lafada cabinets, it's gonna be worth a fortune. On an equity loan, it's the value as is. And so if they've got a lot of equity, fine, that'll work. But if they don't, then the renovation loan is the solution.
That's good.
Cool product. Yeah.
I like it.
Yeah. You're choosing your own contractors, you're choosing your own materials, you're folding it into the loan, and it's a way to get something done that in another way would either take a lot of money or a lot of time. Folks need to keep that in mind when they're looking for houses in this market.
Another tool in the tool belt, as they say.
Absolutely. Yeah.
All right. Thanks, everybody, for listening.
Thanks. Give us a call if you want to talk about renovation financing.
Absolutely.